evening. Markets are just warming up right now. And we're going to take a quick look back at some of the developments that we saw late last week, as well as a look forward at some charts. We're going to take you through the S&P 500, the 10-year notes. We're going to look at the U.S. dollar, gold, silver, and crude oil. So taking a look back at last week, Tuesday, we did see the October PPI data come out. We did see a reading of 8% versus 8.5% on headline PPI year over year. So we did see a much better than expected PPI reading. Of course, that is on the back of the declining CPI number that we saw in the previous week of 7.7% headline CPI. So, of course, PPI begets CPI, and we did see producer prices cool. Month over month, we did see those cool 0.2% versus 0.4% expected. Wednesday, we got retail sales out that came in 1.3% month over month. That's higher than expected of 1% and a previous reading of 0%. So that's not something that the Fed wants to see. The Fed naturally wants to see sales and retail sales and consumer spending cool down from this point. Thursday, we did see the initial claims readings that came out, 222,000 versus 226,000 previously. Once again, not something that the Fed wants to see. The Fed wants to actually start to see those initial claims numbers begin to rise. And then on Thursday, we did hear from the most hawkish member of the Fed outside of Jay Powell, Jim Bullard out of the St. Louis Fed, who actually threw out a Fed funds target of potentially 5 to 7% going forward. You have to remember that Jim Bullard is not a voting member in 2023, so he's kind of getting his last licks in from that regard. So you're gonna see a lot of bulls happy to see Jim Bullard go out into 2023. So S&P 500 finished the week pretty choppy week. It was down a 0.5%. The Nasdaq was down 0.79%, and the Russell 2000 actually led on the downside at down 1.76%. We did see gold lose 1% last week following a very strong 2-week rally in the gold market. Oil prices were down 9.95% in oil, copper down 7%, gasoline prices were down 9%, and natural gas was the bright spot in the commodity space. That was up 8.5% for the week. So as we move into this week, of course, it's going to be a holiday shortened week. This is historically one of the most bullish weeks of the year for the stock market. I have been seeing a lot of things. Throughout this entire year, traders have been trying to find an analog, a past cycle or a past year that we could point to and try to compare what we're currently in right now. I saw some comparisons over the weekend to 2002, where we did actually see the stock market down 31% year to date. However, for the month of November alone, we did see a 12.5% rally in 2002 in November. And right now, 2022, we are up 2.5% for the month. So we're going to see if the seasonalities can kick into gear here this week and out into next week for a little bit of a hiatus from the bear market trading that we've seen here in the S&P 500. So let's get into the charts here. First, we're going to pull up a look at the December S&P 500. That doesn't look like the December S&P 500. Let's get the S&P 500 up here. All right, here we go. December S&P 500. So clearly what we're staring at here on the daily chart, a clear bearish structure that's been going on all year long. You can actually see a better view of that on the weekly. Let's take a look at the weekly. Clearly a well-defined downtrend that we've seen. We've got the trend line resistance that comes up. Obviously, we saw the fit at the beginning part of the year. Then we saw the March rally, kissed the trend line, saw another fit. Then we saw the summer rally, kissed the trend line, and failed once again. And here we are right here back on one of those bullish trades, we'll call it. Clearly, we measure trend on a 3 to 6 month basis and trade on a 1 month basis. And we have seen a choppy upward bias in the S&P 500 for the better part of the last 30 days. So clearly it's been a choppy, kind of sloppy upward pattern. Here's this big move higher, this candle right here. This was the October CPI reading that came in better than expected. So this has got a lot of energy that's still pushing up on this on this price action right here. I'm closing in on an immediate term oversold signal. I don't quite have that just yet. So perhaps we see a little more check down in the S&P 500 here over the very near term before perhaps we've got something bigger to say going out into the end of the year. Let's put a drawing on this, kind of give you a better idea of what we might be seeing. Down here, this was a pretty good support area last week. It was this prior peak that we saw back at the end of October. We did test that this week, came in, and it did hold that 39.30 area. So we're going to see what happens from here. Perhaps we get a little more check down across to this near-term uptrend that we've got drawn in there on the chart, and perhaps we've got something bigger to say up going out into the beginning part of December. Of course, we've got this trend line here. We'll see if that can hold. We've got the 200-day moving average, and we've got our the top of our dynamic range coming in here. So as you can see, after this big move higher in CPI 2 weeks ago, we were getting a pretty strong immediate term overbought signal. You can see that down here in the oscillator. And now this choppy sideways consolidation, that the market is burning off that overbought signal, and it's almost coming into an immediate term oversold signal with positive momentum here on the chart. So maybe we do sneak into that 39.30 area one more time before we try to push higher. We'll see how it responds, of course, at the 200-day moving average, and of course at that downward, year-to-date down trend line, and whether or not we continue to break down from there, or if we can continue to push higher out into the end of the year. If the path moves higher and we do take out this trend line, the next obvious target in this market is going to be this past peak that we saw from back in late August. But we still remain very bearish on this market from a cycle standpoint. However, we do recognize seasonal trends, and seasonals do favor some upside. From what I'm seeing here, I do have a bullish trade that's developing. So perhaps we can push a little bit higher into this 40.50 to 4100 area before perhaps this market does once again break back down to the downside. This time frame out in here, it's about mid-December. And of course, mid-December is the next time we're going to get a CPI reading. And then following that up the next day is going to be the December Fed meeting. So still very much expect to hear a hawkish Fed going out into that December meeting. So that is a look at the December S&P 500. So we're going to switch over here to the 10-year Treasury Index. As you can see, clearly a bullish structure that we've seen develop for the better part of this year. Then out here, we did see something change. Of course, this big candle and push on the downside was on the back of the October CPI reading. And now we've seen this market just kind of chop sideways to down. So we did break momentum here on this move to neutral, and now we're starting to see momentum turn bearish. I don't quite have an immediate term overbought signal here coupled with the bearish momentum. This chart still technically in our model remains bullish trend, but we do recognize a breakdown here on the chart, and perhaps this market might try to pop up into here before we get another move back down out into that mid-December Fed meeting. So it's going to be interesting to see how yields play out. I do think that there is some room for yields to come in from here. Taking a look at this line right here, this is trend in our model, 355. So the market is likely, we think, going to test that 355 area, perhaps get a little bit below it. We do have a trend line that comes in all the way down at 320, and then we're going to see how yields respond from there. I don't have much hope for too much downside in bond yields. Obviously, the Fed is hell-bent on fighting inflation. We have started to see some of the inflation numbers start to come in, but will a 4%, or I'm sorry, at the end of this year, we should, or out into early next year, 5% Fed funds rate going to be enough to bring inflation, that 7.7% CPI reading? Is that going to be enough to bring the inflation levels back down towards Fed targets? I still have my doubts on that. So as you can clearly see, we got a breakdown, a modest breakdown here in 10-year yields. Next downside target is going to be 355. Perhaps we try to push up in here over the very near term, give us an immediate term overbought signal with bearish trend, and then see the market roll over one more time before perhaps you see some more upside out into 2021. So that's a look at the 10-year Treasury index. We're going to move over to the U.S. dollar. Clearly, we see a big breakdown in the U.S. dollar. You can see a theme that's developing here, and that's all about the CPI reading. We did see this move, this big candle, this big push down come on the back of the October CPI reading. And clearly, the U.S. dollar has suffered a near-term breakdown. But if you take a look at the weekly, I'm still very much staring at a weekly chart that has a lot of bullish forces on it. So clearly, we got that big breakdown that week of CPI. Market seems to be consolidating right now. We're going to take a look at the daily again. Perhaps we do get a little bit of a bump up here, but we still have some room to fall, we think, back down to this support area that comes in down at 105 before perhaps we see another bounce back in the U.S. dollar. And then if the U.S. dollar has something bigger to say on the downside, it's probably going to say it at some point out into 2021. And is that going to be on the heels of a Fed pivot? We will certainly find out soon. We'll cross that bridge when market conditions change. So that is a look at the U.S. dollar. I am actually getting an immediate term overbought signal here with clear bearish momentum on the chart. So the U.S. dollar, like we mentioned, still has some room to come in, we think, before it finds much solid footing. And we do see another push higher out into the end of the year. Now, what would cause this push back higher or for this chart to rescue itself? Once again, the Fed meeting out in mid-December. If we do hear another hawkish Fed meeting, we do think that the U.S. dollar can trade back on the upside. So that is a look at the DXY cash market. Switching over to gold here. Gold's had a nice little run over the last 2 weeks. You can clearly see that. Let's take a quick look back first before we get into gold here. We'll look at a weekly chart here. Clearly, we've seen this downtrend develop for the better part of this year. Then, of course, we did see something change in gold. We saw this triple bottom develop in the gold market. We did see the big push higher off of the, of course, October CPI reading. And then we saw 1 or 2 days of consolidation. And then we did actually, in fact, break that downtrend line that we've been staring at all year and respecting. So price action finally pushed through, took out 1738, which was important in our model because that flipped the chart back to bullish trend. And we did see the market make a run as high as 1790 recently. There's the 200-day moving average up there. There's more chart resistance, natural resistance that comes in closer to 1820. We are seeing the gold market start to burn off that immediate term overbought status that it had following this rally. And we are now, in fact, staring at positive momentum, bullish trend, and immediate term oversold right now in the gold market. So if price wants to consolidate and come in a little bit further, we do think it's going to respect this 1740 area. So what was once resistance now becomes support. Perhaps we kiss that level and we retest higher to the top end of this dynamic range, the 200-day moving average, and perhaps this peak up here from back in mid-August. So that is a quick look at the gold market here. And then we actually have gold falling one more time, all the way back to 1700. That'll be interesting to see if that does, in fact, develop. Let's take a look at the weekly chart. Weekly chart, you might be able to see it a little bit better, where we think that we could be getting this inverted head and shoulders look developing on the gold market, which, of course, would take price back down one more time to make that right shoulder before perhaps gold has something much bigger to say out into 2023 on the upside. What could push gold prices higher out into 2023? Well, in fact, potentially a pause in interest rate hikes by the Federal Reserve. So we're going to be watching that going forward. That's a look at the December gold contract. Switching over to silver here. Quick look at silver. I don't usually put silver on the charts here, but it is one that I'm looking at because I am considering some bullish strategies, putting those out there perhaps this week in the silver market. So silver clearly Year to date, we're down 13%, by the way, in the silver market. But we do have this bottoming structure that has taken place over the last several months. And now we're clearly seeing a positive upward bias in the silver market. We did see silver run as high as 2250 recently, took out this peak of resistance. And now we are starting to see the market consolidate, pull back some. We do have a buy zone here off of this trend line, this near term trend line that comes in right about 2050 before we could perhaps see another resumption of the move higher. These yellow lines up here, these are Fibonacci numbers. So this would be the 61.8%. And you can see over here on this side of the chart, there isn't much in the way of resistance until all the way up here that comes in up around 25, 26 in the silver market. So we're going to be watching that market very closely. Clearly positive momentum. I'm getting the oversold signal down here, and we've got a developing bullish trade taking place right now. If we can get above this, we're going to call it 2250 one more time. That is going to flip the chart to bullish trend. All right, that's from bearish trend for the better part of this year. We're currently bullish trade, and another push higher through 2250 is going to flip this chart to bullish trend inside of our model. So we're watching this very closely. The silver market is starting to shape up pretty nicely, and this structure down in here, this just looks like a large bottoming process that we've been for the better part of the second half of this year. So that is a look at December silver. We're going to switch over to the crude oil market. Crude oil obviously had suffered a massive breakdown on the charts last week. We did see it on Thursday, this push lower on Thursday. We took out 81.50. We did warn a lot of our traders that that was a pretty big level that we took place. We thought we might get one more bounce into the midpoint of this range that we've seen in crude oil, and that did not take place. We actually, in fact, just continued to break down on Friday, and crude oil actually still looks like it has some room to come in. The next logical area of support on the chart is going to be this area down here, which was 76. We made that back out at the end of September. So we're going to test down here. We could probably get a bounce. I would expect bulls to defend this 76 area. Perhaps we get a bounce back to what was once support becomes resistance before we perhaps get another breakdown out into the end of the year in crude oil. So that's very interesting. We're going to be watching that closely. Crude oil, clearly bearish trend in our model. We did actually have a moment over here where we did push back to bullish trend. We failed at this past peak, and we haven't really looked back on the downside. Clearly, we've got negative momentum, and we actually are starting to, we did burn off some of that immediate term oversold status that we saw on Friday, to where this oscillator could potentially push back down into oversold. That, of course, would coincide with a push back towards these lows that come in down along 76 in crude oil. So that will conclude our session here for the week. I hope everybody enjoyed that. If you like us doing this view, this look at the charts, please feel free to reach out, drop me a line, and be more than happy to do this more often. Best of luck to everybody out there. Everybody have a happy Thanksgiving. We'll catch you back here next week. Have a great day.